Physical Gold Fund presents the Gold Chronicles with Jim Rickards. Insights and analysis about economics, geopolitics, global finance, and gold.
John Ward, on behalf of Physical Gold Fund, we're delighted to welcome you to the latest webinar with Jim Rickards in the series we're calling the Gold Chronicles. Let me just remind those of you that know and introduce to those of you that are new to the webinar Jim Rickards. He's a New York Times best-selling author and the chief global strategist for West Shore Funds. He's the former general counsel of long-term capital management, a consultant to the U.S. intelligence community and to the Department of Defense. He's also an advisory board member of Physical Gold Fund. Hello, Jim, and welcome.
Hi, John. How are you?
Very good. Except, just to add to our little challenges, I'm recovering from a bit of a cold. If I cough for a moment, my apologies. I'll try to mute myself before that happens, but it is just possible. So, we also have with us Alex Stanzik, the Managing Director of Physical Gold Fund. Hello, Alex.
Hello, John. Great to be here.
Alex will be looking out for questions that come from you, our listeners. So let me just say that your questions for Jim Rickards today are more than welcome. You can post them at any point during the interview. You'll see a box on your screen for typing in your question. And as time allows, we'll do our best to respond to you. Well, Jim, I'd like to begin with a recent statement made by John Poulson. He's a highly respected, well-known within the financial community hedge fund manager. Mr. Poulson said pointedly that we are not facing an imminent financial crisis. Obviously, he had a reason for wanting to say that in the current climate. Let me contrast that statement of John Poulson with a bulletin also recent from the Royal Bank of Scotland advising its clients to sell everything. So my question to you is kind of simple. How near are we to a really cataclysmic breakdown in the world's financial markets?
Well, on this question, John, and I'm certainly one of those who does see a cataclysmic breakdown coming, but I would say not yet. So I'm with John Poulson on this. I look at the landscape today. I look at the landscape over the maybe bridge line or the one after that. I think we can see 1987 was an example of a financial panic with no recession. 1990 is an example of a recession with no financial panic. And 2008 was an example of both. We had a very severe recession, the worst since the Great Depression, and a very severe financial panic. So the point is, there are different things. They can run separately or they can run together. Right now, while I certainly anticipate a financial calamity in the years ahead, I don't see that happening right now, but I do see a recession and a stock market decline, and that's the way to reconcile a lot of what you're hearing. So when Paulson says we're not facing an imminent financial crisis, I agree with that, but that's not the same as saying we're not facing a slowing economy, we're not facing recession, we're not facing a declining stock market, because I think we are facing all three of those things. So when someone like the Royal Bank of Scotland sends an advisory to clients saying sell everything, they're really commenting on the markets and the recession, not a financial catastrophe. So we can expand on that because I know we want to talk about the Fed and monetary policy and the impact on gold and some other things. But basically I would say we're not facing a calamity, but we are facing a recession, further declines in stock markets, and a lot of volatility in exchange markets and gold. So a lot going on, but not quite the big one, as they say in California.
Well, let's look at an aspect that is, at least at the beginning of the story, is purely financial. Of course, it has economic implications. But I want to talk about negative interest rates. The negative interest rates have become something of a craze among the world's central bankers. We've got the European Central Bank, Japan, Switzerland, Sweden, among others, all piling in with this strategy. Now, by some estimates, that's about $6.5 trillion in sovereign debt, trading below zero. And even in the United States, the Fed has asked the banks to test the possibility of negative rates. And yet, at the same time, Janet Yellen continues to insist that the Fed is on course for raising rates, which all seems a little bit Alice through the looking glass. Can you help us make sense of the signals here?
Yes, I think when you say Alice through the looking glass, that's a very good metaphor, because once you cross zero, you are really through the looking glass in more ways than one. There are several reasons for negative rates. The main reason is to try to manage exchange rates and currencies. In other words, it's an extension of the currency wars. Now, the central banks will say this is for stimulus. That is, the theory is, with the negative rate, I'm actually charging banks to have a deposit with me. So I'm the central bank, banks in my system. So in the case of the European Central Bank, we'd be talking about, Deutsche Bank, Credit Suisse, UBS, the other large European banks. They deposit money with the European Central Bank. And the European Central Bank is saying, fine, you deposit with us, we're going to give you less at the maturity of your deposit. We're going to take away part of your deposit. That's a negative interest rate. Instead of paying you interest, we're going to take something away. Now, superficially, they say, well, this is an incentive to go out and lend it. In other words, you can do one of two things with your money. You can lend it to some business or some enterprise or trade finance or commercial finance or anything you like, any commercial loan, or you can leave it with us and we'll take it away from you little by little in small increments. Therefore, that negative rate is an incentive to go out and lend. But in fact, that's really not different in kind than the incentives that we've had in place for the last 8 years. In other words, if I could lend money at 1% or 1.5%, how much does it matter to me if the rate's 0 or negative 25? Well, I guess if you go negative 25, negative 50, negative 1%, at some point it might matter, and maybe we'll get there. I mean, things certainly are moving in that direction. But the reason that the banks haven't loaned out the money is because nobody wants to borrow it. In other words, between regulators imposing strict credit standards, between corporations that the big ones have plenty of cash, the small ones are perhaps not creditworthy, or they're looking at below-trend growth and saying, why would we want to borrow money to buy plant and equipment or expand our capacity? Why would we want to do any of those things? We're worried about growth, we're worried about leverage, we're worried about a new recession, we don't want to borrow. Consumers, same thing. Consumers, when they get their hands on money, the tendency is not to spend it, but to either save it or pay down debt. So we have an excess of savings over investment. We have deleveraging in the form of paying off debt. We have banks that don't want to lend and consumers and businesses that don't want to borrow or spend. And so the system is jammed up. The transmission mechanism between central bank money and commercial bank money and lending and spending is very badly broken. So going down another 25 or 50 basis points isn't going to change that. The problem, the impediments, are psychological, they're structural, they're long-term. It's not because interest rates are too high and they need to be lower. Interest rates have been very low, too low for a long time. As I say, the impediments are elsewhere, and lowering rates is not going to change that. So superficially, they will say this is designed to have a stimulus, but there is no stimulus. If 0 didn't do it, 25 basis points negative won't make much difference. However, there is a reason, at least in the minds of central banks, for lowering rates, including negative rates, and that's to fight the currency wars. It is designed to cheapen your currency. If you are a major institution, you're a sovereign wealth fund, or you're a very large asset allocator like BlackRock or PIMCO, or even a bank or the aggregate of all the savers in the world, if you're deciding where to park your money, you've got several choices. You can park it in Europe, you can park it in the United States, Japan, etc. At the margin, you're going to park it where you can get the highest rate. So if the U.S. is positive 25 or maybe soon to be 50 basis points and slightly higher for banks, and Europe is negative, then you'll put your money in the United States. Well, that means that at the margin, they'll be selling yen, selling euros, and buying dollars. That has a tendency to cheapen the euro. So there is an agenda, if you will, but the agenda is not normal stimulus through lending and spending. It's backdoor stimulus through currency wars, cheaper currencies, importing inflation. But the problem is, and that's why Europe's doing it, Switzerland has done it, and others are doing likewise, Japan, Sweden, and the other countries you mentioned. Now, the U.S. is not doing it. In fact, the U.S. is moving the other direction. The U.S. is in a tightening cycle. This combination of tightening in the U.S. and negative rates in Europe, of course, has driven the dollar at this point close to 10-year highs, and it's driven the euro quite low. So that's the dynamic that's going on. The question is, where do we go from here? What's next for the U.S. Central Bank? What's next for Europe? And if you like, John, I kind of expand on that. Do a longer-term central bank forecast.
Well, I think it'll be helpful, actually, because I think the sense of what's the future of this is a question on all our minds.
Right. The Fed is still on a path to raise interest rates. I expect the Fed will raise interest rates at 25 basis points in March and again in June. Now, I'll watch June carefully. I may update the forecast between now and then. In fact, I update my forecasts on a regular basis. But as I sit here today, I expect two more rate hikes by the Fed, 25 basis points each, one in March and one in June. And why do I say that? Because certainly if you listen to market chatter, if you look at the Fed funds futures markets, if you look at financial television, you hear the opposite. You hear that the Fed has suddenly gone dovish. They did the one rate hike in December, but markets nearly collapsed in January. We went well into correction territory, depending on the market, into actually bear market territory. It wasn't quite as bad as the drop last August, but almost as bad. We had the Fed come out with their January statement that was released at the end of January, and then the minutes from that meeting, from the January meeting that were released yesterday, they were taken by the markets to strike a very dovish tone. And what has happened is that the market has now formed an expectation that the Fed will not raise interest rates in March. Of course, I'm saying that they will, so a bit contrary or well outside the consensus. But let me explain my view and sort of what it looks like the market is thinking. So the market, and when I said the market, I mean it shows up in the Fed funds futures markets, which based on where they're priced are showing that they don't expect any rate hikes in 2016 at all, with only a very small probability perhaps of one rate hike late in the year. And stock markets have started to rally. So what the stock market did, and by the way, go back to December when the Fed raised rates. I certainly, I had a year 2015 that they would not raise rates until December when I said they would, and the market certainly expected. I don't know anyone who did not think the Fed was going to raise rates in December. The rest of the year is history, but by December it was clear that they were going to raise rates. That was very, very well advertised. But I also said that would be a blunder. I was not in the group that said, a 25 basis point hike is not a big deal. It's only 25 basis points. Who cares? I said at the time that they would raise rates, but that it would be a huge blunder on a par with what they did in 1929. It would produce very, very adverse results. Well, that's exactly what happened in January. We all know what the stock market did in January and early February, and it went down quite a bit. But so the market was saying to the Fed, look, you have made a mistake. You've tightened into weakness. The Fed is not supposed to do that. They're supposed to tighten when things are strong and labor market conditions are tight and inflation is ticking up. That's when they're supposed to tighten. And when you're in economic weakness, you're supposed to ease. But here was the Fed tightening in weakness because there was a lot of weak data from trade and manufacturing output trade, strong dollar. There were just credit losses, energy prices, commodity prices, shipments out of major ports. There were a long list. Retail sales, inventory skyrocketing. A long list of data that said the U.S. economy looked like it might be in a recession or heading for a recession. Why on earth would you tighten in that environment? Well, the Fed tightened anyway, and the reason is that they are not really looking at real-world data. They're looking at their models. They have a Phillips curve model. They have something called NIRU, the non-accelerating inflation rate of unemployment. We don't have to debate the technicals of those models except to say that they're, in my view, they're pretty much junk science that don't really have any real-world validity. That's what the Fed was using. So the Fed was tightening based on models that told them growth would be okay and inflation was right around the corner. Meanwhile, the real world is seeing weakness all around, seeing the Fed tighten, and said that's a blunder. So the stock markets collapsed over the course of January. But then a funny thing happened in the last couple of weeks, which is the minutes, the January minutes came out, as I mentioned, and they were interpreted by the market as striking a very dovish tone. Now, what was the basis for that? Well, if you go look at the language, the Fed acknowledged the financial stress that we were all seeing in the month of January. They said, Chinese markets are going down, U.S. markets are going down, markets are volatile, financial conditions are tightening, growth appears to be slowing. They listed a litany of things that would indicate that they recognize that the U.S. economy is fundamentally weak. So the market said, okay, good, the Fed got the message. They tightened in December. That was a mistake. The markets went down, but the Fed heard us. And now the Fed is acknowledging that the economy's weak and they won't tighten in March. Now, here's where I disagree with the markets. But markets are wonderful price signals. They're wonderful aggregators of information. I follow them very closely, but they're pretty bad forecasters. So I don't rely on them on forecasts, but I do rely on them for information. Of course, the art of the exercise is to interpret it correctly. What I saw the market doing when they looked at these Fed, first the statement, then the minutes, and went down the slide of weak factors, I think they ignored something else the Fed said, because the Fed said, yeah, we have weakness here, volatility there, tightening financial conditions. We're watching it very closely. And that was the key phrase, because watching it means that they haven't changed their minds. In other words, they set out on a path to raise rates, certainly in March. Some unexpected things happened. They acknowledged the unexpected things, and they said they're watching it, but that tells me that they haven't seen enough yet to change course, because if they had, they would have said that, but it's not what they said. They said, we're watching it, and we're going to keep thinking about it. That means they're not changing course. And whenever you answer one question, it should always pose another question. And so what I said to myself was, okay, the Fed's still on course to raise rates. The market has kind of looked at the dovish part of the statement, but I looked at the part that said, yeah, well, there's some dovish factors out there, but we still haven't made up our minds. So that tells me they're still on course to raise rates. But then I said, well, what would it take if they're watching this data? What would it take for the Fed not to raise rates? In other words, it's not bad enough yet. That's what they said, but how bad would it have to be? Well, we do have some information on that, which is the collapse last August, particularly the last week of August, and the fact that the Fed did not raise rates in September 2015, when they were widely expected to raise rates, certainly all year by a lot of commentators, but in the run-up to September 15th, it was very widely expected until the last few days that they would in fact raise rates, and they didn't. So there's an example when the Fed did change course based on market information, and using that applied to today's markets, where would the S&P have to be for the Fed not to raise rates? That was the question I asked myself. And the answer is about 1650. You know, that's an estimate, and it could be a little bit higher, a little bit lower, but you would have to see the S&P crash from where it is now around the 1920 level all the way down to 1650 for the Fed not to raise rates. What about jobs? We're going to get a jobs report on March 4th. That'll be the February jobs report. That'll be the last big piece of data before the Fed has to make their decision on March 16th. The January jobs report that came out in early February was decent. It wasn't huge. It looks like monthly job creation actually peaked in November 2014, right around the time the stock market peaked, by the way. That's when the trouble began. There was a delayed or lagged reaction to the Fed tightening beginning in the spring of 2013. But anything above 100,000, it's not a blockbuster report, but it's good enough. So my estimate was that in order for the Fed not to raise rates, you'd have to see a February jobs report of, say, less than 100,000 new jobs on March 4th, and you'd have to see the S&P tumble down to the 1650 level over the next couple of weeks. If both of those things happened, then the Fed would not raise rates in March. But I don't see either one of those things happening. I think the jobs report will be okay, not huge, but good enough. And the stock market down, but there'll be counter rallies, and it's not going to hit, even 1700 would be a shock, but I don't see it hitting 1650. So with sort of 1650 on the S&P and sub 100,000 jobs in the February jobs report being my benchmarks, and neither one of those things happening, I don't see the Fed being deterred from raising rates in March. Beyond that, the market has made the Fed's life easier because of what's called a recursive function. That's just a fancy name for a feedback loop. So go back to the December, January, February sequence. The Fed tightens in December. The market decides the economy's weak. That tightening in weakness is a mistake. So the market goes down. Then the Fed acknowledges the market's concerns. The market interprets that as being dovish, and the market rallies. Well, the irony of that is the market rallying makes it easier for the Fed to raise rates. In other words, markets are rallying in anticipation that the Fed won't raise rates because of a statement, but the market rally itself makes it easier to raise rates because it eases financial conditions. So it's the exact opposite of what the market may be expecting. So all of that is a setup for possibly a shock on March 16th, where if the Fed tightens as I expect, but if the market's looking for no action, certainly nobody thinks the Fed's going to ease, take back the 25 basis points that they raised, but even doing nothing would be sort of dovish from the market's perspective. So if the market expects the Fed to do nothing and the Fed tightens, that could be a shock. So we could see much bigger declines in the stock market between now and then, and perhaps even very much concentrated on March 16th if the Fed actually does tighten, which I expect.
You have been listening to The Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.